Welcome everybody to today's Finance Bill update in association with Deloitte. We're really delighted to have them on board with us for today's event. Today we'll have Carmel Murnan, Anthony O'Halloran and Fergal Kenzie, all directors with Deloitte Ireland. Carmel specialises in working with domestic businesses and their owners. Anthony is a corporate and international tax director, and Fergal focuses on tax controversy. So just to note, today's meeting is being recorded. If you do have any questions, we'd appreciate if you could use the Q&A function and just keep the chat box for any technical issues. And with that, I'll hand over to Carmel.
Thanks, Jennifer, and good afternoon, everybody. So as you could probably see there from the agenda, I'm going to start off today's session and look at the domestic tax measures that came through in the Finance Bill. And within that, I'm going to look at some corporation tax measures, carbon tax related measures, and personal tax measures. So firstly, if I look at the area of business taxes, there's a relief, as many of you will know, that's been in existence for quite some time now for startup companies. The relief operates for startup companies that have commenced a new business. And the aim of the relief is to reduce the amount of corporation tax they pay in the first 3 years of their existence. The mechanics of the relief have been that it's capped at €40,000 per annum, and it's directly linked to the amount of employer's PRSI that the company would pay in the same year, with a maximum cap of €5,000 PRSI per employee. So in recognition, I suppose, of the difficulties clearly that businesses have suffered since COVID has hit us, and given the fact that obviously employers' PRSI was reduced in that period, the scheme is actually going to be extended out from a period of 3 years to 5 years in terms of availability to claim. So what this means is that the extension from 3 years to 5 years is being opened up to businesses who have been within the scheme or within claiming the relief since 2018. And also, in addition to that, more generally, the scheme is actually being extended out until the 31st of December 2026. The next area I'm going to look at is the Employment Investment Incentive Scheme, or more easily known as the EIIS scheme. So during 2020, this scheme, which is the, I suppose, the follow-on or was meant to be an improvement on the old BES scheme, during 2020, the scheme was subject to a stakeholder review, which was, I suppose, hosted by the Department of Finance and sought to get input from interested stakeholders and parties who have either used the scheme in the past or would like to use it. And really, you know, anybody who's in any way familiar with this scheme will know that it's quite unwieldy, and there's like reams of terms and conditions that apply to it and many possibilities for clawbacks. So essentially, the purpose of the scheme is to encourage investment in SMEs within the country. So while we have seen some changes come through in the Finance Bill, they're certainly not a wide sweeping change, but they're certainly a step in the right direction. So if we look then at what actually has changed, first of all, as the scheme stands right now, you can, if you want to avail of this relief, you can invest directly in an SME, or you can invest through a designated investment fund. So in a bid to try and extend out the ways or the vehicles through which people can invest, it will now be possible to invest into one of these schemes through a limited partnership or an investment limited partnership, assuming, of course, that they have gotten the required approvals from Revenue, which currently still apply to designated investment funds also. The second change is around the capital redemption window. And as I mentioned there just briefly a moment ago, there are many, I suppose, ways in which you can fall foul of a clawback in this scheme, one of which is where an investor may receive some return or redemption on their capital within their compliance period. So the aim here of this measure is to try and, I suppose, give greater flexibility and capacity for investors to get some of their money back without actually giving rise to a clawback of their EIIS relief. And the other change in relation to the EIIS scheme is the fact that up to now, you had to, the business that had gotten the investment would have had to have spent at least 30% of the monies invested before they'd be able to issue a certificate or a qualification to the investors. And that is actually going to be amended also to reduce that 30% threshold, which is again a positive move. And they're all positive moves, certainly moving in the right direction, as I said, for the scheme. So the next tax, which has been introduced, which again I suppose is coming from the Housing for All plan, that has certainly been prominent in the last few years and will continue to be so, is the zoned land tax. Now, this actually replaces the vacant site levy. So the intention here is to try to free up more land so that more residential units can be built. And what it means is that for businesses or for individuals who fall foul of it, that they will have to pay a tax which is equal to 3% of the market value of the land in question. So I suppose just to look at the land that will actually be in scope here, we'll be looking at land that has been zoned suitable for residential development. It could be zoned suitable for residential development on a standalone basis, or there could be a residential component within a mixed use development. It's service land, but it might not be yet developed for housing, and it will be land that could be included in maps of zoned land that are yet to be published by the local authorities. So a few, I suppose, interesting points to note in relation to this scheme. First of all, there would be no proposed minimum site exclusion. So any size of a site potentially could fall within this tax. There's going to be a 2-year lead-in window for land that has been zoned residential pre-January 2022. So the tax for those affected then wouldn't kick in until 2024. And there would be a 3-year lead-in window for land that becomes zoned post-January 2022. Now, as I said, or as you'll see on the slide there, it is a self-assessment tax. So I suppose in terms of establishing market value, it would be up to the taxpayer to establish that, and I guess be able to support that in the event that it is ever questioned. And finally, just to note that there are exemptions from it. And clearly those exemptions will be aligned to where land is being used for residential or supporting residential use already. So the examples that have been given thus far in that area would be land that's already occupied by dwelling houses, or gardens that are used for common use, and other amenities and infrastructure that supports residential development within the greater area where they're based. The next change to mention is around the area of non-resident landlords, and this is a change that actually came in purely in the finance bill and hadn't been touted in the budget last month. So from the 1st of January 2022, the tax on rents that arises for non-resident landlords will be 25%. Now, heretofore, that rate of tax would have been 20%, and it would have been captured under the income tax system. So essentially what's happening here from 1 January 2022 is that rents that arise to non-resident landlords will fall into the corporation tax system and be taxed as rents would be in that scenario at 25%. Now, Revenue or the Department of Finance have said that the rationale for this is not to make it a revenue raising measure as such, although I guess that might be a output that comes out of it anyway, but it's more to do with the fact that they want to align the corporation tax that arises on rents with the ATAD interest limitation rules that Anthony will mention later in more detail. So because of the fact that this type of scenario for rents for non-resident landlords is going to be moving from an income tax structure to a corporation tax structure, amendments are being made as part of the finance bill to transfer, for example, if there was losses within the rental scenario and also capital allowances, that they will equally transfer from the income tax base to the corporation tax base for this property. And then one to watch is in relation to what's going to happen with the, I suppose, interaction with interest deductibility rules. The applicable legislation there is Section 840A. Now, previously, these rules wouldn't have affected rents for non-resident landlords because they were within the income tax system. But now that it's coming into the corporation tax system, they will in theory be affected. And just to explain those at a very high level, they can deny interest deductibility where interest is being paid on a connected party debt, where that debt was being used to acquire connected party property as well, for example. So there has been some submissions to the Department of Finance in relation to this particular point since the finance bill issued. So it's certainly one to watch to see how this develops, because it could become quite punitive if the rate goes up to 25%, but equal to that if there's certain restrictions on the interest that come into play for the businesses affected. So then moving on to the area of carbon tax, and I mean, not surprisingly, this budget and finance bill now and previous ones, and certainly in the last few years, have focused heavily in this area, given where we're at in a global context in that area. So the first measure to tackle climate change is I think what was dubbed as well as by the minister as a modest change. And essentially what this is, it's going to give a €200 income tax exemption for households that are supplying their own electricity and have surplus electricity that they can supply back to the national grid. Again, a climate aimed measure, and one that's obviously aimed at trying to encourage people to buy more energy efficient vehicles. The VRT table is being amended, so this affects vehicles that would have been or that are in bands 9 to 20. So essentially, it means an increase in the rate of VRT that would apply to vehicles that come within those brackets. And just to note that the bands themselves haven't actually changed. Further changes then in the climate space around battery electric vehicles. First of all, there's been confirmation that the €5,000 relief will be extended up until the end of 2023, because that was due to expire at the end of this year. The BIK exemption for battery electric vehicles will also be extended out to 2025, albeit there will be a tapering effect on that from 2023, which is going to apply to the original market value of the car involved. And also just to note that the relief for plug-in hybrids was reduced from the 1st of July of this year from €5,000 to €2,500, and there's been no mention of a change in relation or an extension in that space. For companies who are acquiring equipment and that equipment can come in the energy efficient space, the accelerated capital allowance scheme has been extended out to the end of 2024. So the way that scheme worked was, if businesses bought particular equipment that was on an approved list from the SEAI, then they could claim 100% write-off from capital allowances for that asset in the year of purchase, as against the normal 8-year capital allowances period that you'd have for normal capital allowances or non-energy efficient ones. So as I said, that scheme is being extended out to the end of 2024. But within that regime also, there are some very targeted measures around, obviously, the carbon piece as well. So first, to note that it's being extended to include hydrogen-powered vehicles and refueling equipment. And also importantly, and I suppose on the converse side of that, equipment that is directly operated by fossil fuels will no longer qualify. So again, all targeted measures to encourage people to go the more energy efficient route where possible. So then just to turn briefly to the area of indirect taxes and excise. So the 13.5% rate of VAT that applies generally to the likes of the tourism sector and hairdressers, that was reduced to 9%, and that temporary reduction has now been confirmed to stay in place until the end of August next year. There was a slight reduction in the flat rate farmers edition from 5.6% to 5.5%, and that will kick in from the 1st of January next year. I suppose the usual changes we see around fuel at the pumps came into effect on budget night, which was the 12th of October. But the wider change to carbon fuels will come in from the 1st of May next year. Again, obviously, all an increase in the cost of those items to encourage, I suppose, looking at alternatives. And then again, we had the usual increase in the cost of tobacco and tobacco-related products. So I suppose no surprises there, really. In the area of personal taxes, I suppose the message that the department have brought out in this area is that there have been particular adjustments made to help people deal with the cost of living. So in the income tax space, what that meant was we saw a bit of an increase in the standard rate band. We've also seen a slight increase, as you'll see on the table here, in the personal tax credit, the PAYE credit, and in the earned income credit. There have also been some adjustments to the bands for entry for universal social charge and also for employers' PRSI. And you'll see there on the left-hand side as well, which I've mentioned as well previously, the electric car exemptions extended to the end of 2025, with the tapering effect that I mentioned there kicking in from 2023. So nothing groundbreaking there, I guess, but slight adjustments to take into account, to some extent, inflation. The employment wage subsidy scheme, then, there's some changes introduced in that area. And I think in the budget speech in particular, and in previous speeches, the minister would have been very clear that he did not want to see and that there would not be a cliff edge end, I suppose, to this scheme. So again, this has been reiterated in the budget, and then certainly in what has come out in the finance bill on foot of that. So the scheme will keep operating as it currently stands until the end of this month. The scheme will become closed to new entrants from the 1st of January 2022. In an ease around eligibility, businesses will no longer have to, if they qualify under the eligibility criteria, which is generally around a 30% reduction in turnover and customer orders, if they qualify under those comparisons at the end of 2021, they won't have to continue doing those comparisons into the 2022 4-month period where the scheme would still be in existence. So in terms of, I suppose, rate changes from the 1st of December next then until the end of February 2022, there would be a 2-rate subsidy scheme, the rates being 151.50 and €203 per week. For March and April then 2022, which would be a flat rate subsidy of €100 per week. And at the end of April 22, the scheme will, as things currently stand, be abolished. And just to note then that there will be a return to full employer PRSI contributions from the 1st of March next year also. Again, I suppose with a nod to the changes that we've all seen from the pandemic and what it has meant in terms of working structures, an improvement in the working from home allowances that are available to employees. So whilst things currently stand, you can get relief for 10% of your voucher electricity and heating costs and 30% of your broadband costs, which relate to the days that you've actually worked from home. So again, I suppose a lot of the publications here were around the idea that those schemes are going to be improved. And I suppose just from a monetary point of view, how this works is that the voucher electricity and heat, which is currently, as I said, calculated at 10%, is going to increase to 30%. In line with how the broadband allowance is calculated. So in order to actually make a claim on that basis, the taxpayer must file a return with revenue. And I would just flag there that it's the employer ability to pay a €3.20 allowance per day still stands, and that is calculated for each remote working day. And it's interesting if you potentially look at the kind of, I suppose, heating and electricity bills and broadband bills that people might have, that they might actually fare better if they took the €320 allowance a day, as opposed to actually doing the 30% option and putting a claim through their tax return. So that's one that people might want to keep an eye on and even look at their bills as they currently stand to see what might actually give them a better result. And again, just confirmation coming through that there'd be no benefit in kind to be assessed where businesses have provided equipment for employees to work with in their own home. So the final piece for me then is around gift and inheritance tax. Again, the changes that are introduced here were pure finance bill changes, and they're ones that hadn't been touted in the budget. So the first one is an interesting one, and it's around the free use of money. So I suppose specifically, this targets interest-free loans. And I suppose you may have seen some coverage on it in the papers where they were suggesting it's targeted at the bank of mum and dad. So heretofore, if someone and up until the end of 2022, if you gave someone an interest-free loan, then you had to think about, as the person giving the loan, what interest, like deposit interest, you had foregone by virtue of giving that loan to somebody at either 0 interest rate or a reduced interest rate. And clearly in the last few years, if you look at the deposit, I suppose, world, it wouldn't have been hard to argue that the actual rate of deposit interest would have been 0. So what that meant was it was possible to give out loans to family, for example, and not have to charge any interest on it, or at least a very minimal amount of interest. And then between the €3,000 annual exemption and maybe threshold between, say, parents and children, there was no tax to be paid in it. So interestingly, from the 1st of January next year, this I suppose regime will change slightly. So from the 1st of January, it will no longer be about looking at the deposit interest that the lender has foregone by giving the loan, but it would be a case of looking at the interest that the borrower would have had to pay and the best rate they would have gotten if they had to go to a financial institution, for example, and borrow that same amount of money from a financial institution. Now, clearly that leaves a lot of variables potentially up in the air. For example, what about the person's borrowing history? Would that ordinarily maybe affect the rate they might get from a financial institution? Looking at the level of borrowings they're taking down, you might have to consider that borrowing in the context of maybe other borrowings they have. And there's a lot of variables like that, particularly as well, I suppose, depending on the size of the money and if it was being used as a quasi mortgage, then what kind of mortgage offerings are out there in the market. So I think at the moment, the feeling is there's a lot of uncertainty around this and how it will actually operate, but certainly it puts an onus on the borrower to have documentation to back up how they came up with the rate that they did. And I suppose interestingly as well, just to think about the fact that, I mentioned the €3,000 annual exemption, which would still cover them on interest, assuming they haven't other annual gifts coming through to them from, say, their parent, for example. But I suppose what it does mean is in a situation where there might be, I suppose, a habit of a parent giving gifts to a child, for example, on an annual basis, albeit at a small level. Well, this then was something that could potentially eat into their ability to use the small gifts exemption, and also potentially eat into their overall parent-child threshold as well. So it's certainly one to watch. And the final piece for me then is just in relation to gifts also. So essentially what Revenue have said here is that if a person has claimed agricultural relief or business property relief, then they may be required to file a return if Revenue requests them to do so. And what Revenue are targeting here is the current situation where if you haven't used more than 80% of your threshold, you're not actually required to file a return. But Revenue are saying in the instance where agricultural relief or business property relief has been claimed, then potentially they can decide to ignore the 80% threshold and require the person involved to file a return. So again, one to watch. It's really interesting to see how that develops and how frequently perhaps Revenue might actually make such a request. So with that, I will hand you over to Anthony, who's going to take us through the foreign direct investment related changes.
Perfect. Thanks very much, Carmen. Yeah, you can click on. Perfect. So I suppose just to maybe set the scene with respect to foreign direct investment sector, I think it's been the department's and the government's modus operandi to kind of ensure that there are no major surprises on budget day or through the finance bill. And I think the minister has made that comment on many occasions. I suppose nothing in here, that hasn't been flagged in the corporation tax roadmap that was republished in early 2021, or matters that were picked up as part of the public consultation process during the year. And in particular, which we'll touch on later on, is with regards to the reverse hybrid rules and also the interest limitation rules. So if we might just click on, Carmel. So I suppose just with respect to FDI companies, obviously the change that was included in the finance bill with regards to corporate landlords, Carmen has already touched. That one probably was a surprise. With respect to changes on transfer pricing, as many of you will know, there was a generational change in the transfer pricing rules back in 2020, where the department adopted the OECD 2017 transfer pricing guidelines. As part of those guidelines, there was a section included in the Irish legislation in section 835E that provided an exclusion where there is certain domestic to domestic lending. There was some concern that there was gaps in that legislation. Revenue or the department have now, through the finance bill, rewrote that section, and it is included in the latest finance bill. So again, it's probably quite a nuanced section, and unless you're in that direct domestic lending space, it probably won't apply to you. One change as well that would have been well flagged is the legislation for the authorised OECD approach for the attribution of income to branches. I suppose generally when we look at attribution of profits to an Irish branch, we're looking at the treaty, and when we look at the treaty, it talks about treating a branch as an independent entity almost. So you apportion income and expenses on an arm's length basis. However, the change in the finance bill will now bring this into our domestic legislation, and with it will also formalise the requirements for transfer pricing documentation in this area. One other change that was included in the finance bill was with respect to dividends paid out of pre-migration profits. So historically, where an Irish company pays dividends to another Irish company, that's been treated as franked investment income. So there should be no tax pickup in the hands of the Irish recipient. However, there is an anti-avoidance measure included in the finance bill, whereby if a company migrated from a territory outside of Ireland to Ireland and then makes a distribution back up to the Irish parent, that these anti-avoidance rules will apply. So it wouldn't be classified as franked investment income in that respect. So then, just moving on to the next slide, Carmel, just on interest limitation rules. So if you would have attended these seminars or other finance bill seminars in the past, I think the interest limitation rules is something definitely that would have been discussed. The interest limitation rules were first, I suppose, disclosed in the EU Anti-Tax Avoidance Directive that was signed back in 2016. As part of that directive, one of the changes that it sought to introduce was around interest limitation rules. So I guess, in short, the purpose of the interest limitation rules is to deny excess deductions of interest in member state countries. Initially, there was a view that you didn't have to introduce the rules if you had rules that were equally effective in your domestic legislation, that you could push out the introduction of these rules until 2024. The Department of Finance have had some interaction with the European Commission, and even though I suppose as Irish tax advisors, we would view that our rules are potentially quite onerous, especially in Section 247 currently. The Irish regime wasn't provided the derogation, so we've now had to introduce the rules with effect from 1 January 2022. So in summary, basically what the rules do is they seek to deny an excess interest cost in excess of 30% of EBITDA. So excess interest is basically where your interest costs exceed your interest income. So for example, if you're a treasury company, you would expect that you would have your interest income would be in excess of your interest costs. So therefore you wouldn't be in an excess interest deduction space. So then when we talk about 30% of EBITDA, it's 30% of your earnings before interest, tax, depreciation and amortization. It's important to note that there are some exclusions. So, if you're an Irish company and your interest expenses are less than 3 million, you fall out of the rules. Again, that is a cliff edge. Once you go over that 3 million, you're in the rules. If you're a standalone entity, so you don't have any group companies, probably an unusual scenario, the rules shouldn't apply to you. They don't apply to companies that are involved in developing long-term infrastructure projects. And they also don't apply where you have legacy debt, so a debt that was signed and entered into before the 17th of June 2016. So I think, I suppose, from a company perspective, if you have financing, debt financing in your companies, it's definitely something that you will need to think about. I suppose what I see my clients looking at is, they may have holding companies where they have interest deductions. They may not have any EBITDA in those countries or those companies. So they're looking to see, through use of group relief rules, etc., how they can potentially, I suppose, maximize relief, that interest relief. So making sure that, that they are meeting the parameters to be able to group relief that interest. A couple of other points around the interest limitation rules is if you have excess interest in a period, so again, your borrowing costs exceed your interest income, you can carry that excess interest forward indefinitely. And if you have excess capacity, so if you have a scenario where you have your interest costs don't hit your 30% EBITDA limit, you can carry that excess capacity, as they're referring to it as, forward for a period of 5 years. So there definitely is some optionality there. The rules also apply for certain group exemptions and exclusions. So potentially, when you look in a group scenario, if your EBITDA percentage is higher than 30%, potentially you can take a deduction for an amount that is greater than 30% of your EBITDA restriction. Again, these are all points that kind of need to be worked through to ensure that you are maximizing your relief, and to ensure, I suppose, that when you're looking at your provisioning, your preliminary tax, etc., that you are being able to use your interest relief as you would have been able to in the past. And again, just to flag that these rules apply to accounting periods commencing on or after 1 January 2022. So if we just move on, Carmel, to the anti-hybrid provisions. So again, a change introduced in Finance Bill 19. saw the introduction of hybrid rules for payments made after 1 January 2020. Finance Bill 2021 sees the introduction of reverse hybrid rules. So I think probably best explained by way of an example. So where you have an entity in the States, so we have an entity in Ireland, the Irish vehicle here, that entity is treated as a partnership. So there's no tax pickup in Ireland, the income is allocated to the partners. So in this case, we have a foreign company that's the partner. The foreign company treats the Irish entity as opaque. So it treats it as a company, not as a flow-through entity. So there we have a mismatch. Ireland treats it as transparent and allocates any income to the foreign company, and the foreign company treats Ireland as being opaque. So it doesn't pick up that income. So that brings us neatly within the reverse anti-hybrid provisions. So what the anti-hybrid provisions say to us that in that instance, the Irish vehicle must basically tax the income in Ireland as though it were a corporate entity itself. So again, it's probably a case here from a practical perspective, working through kind of group structures and seeing if there are potentially any reverse hybrid Irish entities in the group. And these rules apply again to tax periods commencing on or after 1 January 2022. So it's probably, as I say, a case of working through those structures and just seeing if there are any potential reverse hybrid entities there. So just, I suppose, moving on to the digital gaming tax credit. So again, this would have been the minister announced his intention to introduce a digital gaming tax credit back in budget 2021. He formally announced it in budget 2022, and I suppose we see the devil in the detail now in Finance Bill 2021. So this credit is I suppose, as it says in the 10, to support the design, production, testing of digital games. The relief operates by way of a 32% credit up to an expenditure max of 25 million, and there is a de minimis spend of 100,000. In order to qualify for the relief, a company must apply and receive a cultural certificate. So the game has to have some relevance of Irish or European culture to qualify for the relief. Again, you know, I suppose I'm probably going back to Carmen's example on EIS and some of the stories there around obtaining kind of certificates and self-certification. It remains to be seen kind of how practically this process will work for those in this space. So definitely, I would say one to watch here. There is an exclusion from the relief where the digital game is used for advertising or in the area of betting. Again, the digital gaming tax credit, similar to any change in the R&D tax regime, it does require European state aid approval. So we understand that this regime has now gone to the European Commission for approval. So we'll wait and see there. So obviously, very beneficial for those in an incredibly fast-growing sector. During the minister's budget speech, he announced Ireland's intention to join the global framework and sign up to Pillar 1 and Pillar 2. When looking through the minister's comments from Budget Day, he keenly expressed that signing of the framework was in Ireland's best interest. Again, he kind of referenced the theme of certainty and transparency, and much of the discussion there was around kind of the removal of the at least 15% on the minimum tax, and just making sure that Ireland was well positioned going forward and that they weren't left open in terms of future changes or future amendments to the scheme once they had signed up to the framework. So I suppose just moving on the slide again, when we kind of look at Pillar 2 and the minimum tax. So Ireland joined the landmark agreement to address global tax challenges of digitization digitization. I think this is well discussed. We're operating in a world where our tax rules were developed over 100 years ago, and typically, unless a company has a nexus with a jurisdiction, they probably do not trigger a tax presence there. So this now looks at, I suppose, readjusting and realigning some of those discrepancies that have arisen due to digitization. So just in terms of the global minimum tax, as I said, the minimum rate is been set at 15%, will apply to multinational companies with a group turnover of greater than 750 million. So in an Irish context, there are potentially 1,500 multinationals in the net. There's no change to the 12.5% for those that don't meet the 750 million threshold. I think that securing EU agreement and agreement with regards to the dual approach in terms of the 15% and the 12.5% was definitely a key piece in signing up to the framework. So when discussing this, I suppose, with our clients, while Ireland has signed up to the 15%, and which we'll discuss a little bit later on, much of the technical detail in terms of Pillar 1 and Pillar 2 is still to be decided. And it's still to be confirmed exactly how it will impact Irish PLCs and also multinationals doing business in Ireland. So just moving on quickly to Pillar 1, again, very much tackling digital companies. So it creates a new taxing nexus where a company with a turnover of greater than 20 billion that has a profit margin of 10%, it will basically seek to distribute residual profits of up to 20% to market jurisdictions. So market jurisdictions is basically where a company's end users are. And again, there is a de minimis to trigger an in-country liability of 1 million reduced for developing countries. So discussing this with our clients, it's very much a case of trying to model out the impact, but also trying to understand what exact information they will need to be able to, I suppose, file a return. So we're just moving on the slide to see how this will all impact on Ireland Inc. As we'll have seen from many of the press releases from the department over the last number of months, it's becoming increasingly difficult to forecast our corporation tax receipts. Just looking at the numbers for October, I think we're 2 billion ahead of where we were estimated. Just looking at the slide there, CT is now 21% of our net tax receipts, growing year on year. So it's obviously a huge part of our exchequer income. Then when we think about Pillar 1, Pillar 2, I think initially there was a view that this would cost somewhere in the region of 750 million to 2 billion. I think those numbers have yet to be revised now that Ireland has signed up to the 15%. So again, we'll wait and see where those final projections land. So just moving on again, just in terms of some of the key dates, and many of you will have been following the G7 ministers meetings in June, and then bring us up to signing of the framework in October. So the OECD has a big body of work to do before the end of this year in terms of drafting some technical legislation, and into early next year, so that rules are available to implement into domestic legislation, but also as part of multilateral conventions to implement Pillar 1. So Pillar 1, Pillar 2 expected to be effective from 1 January 2022. So 1 January 2023, so quite a bit of work to go through throughout 1 January or 2020, throughout FY22. So just moving quickly on to the last topic on my slides, and again, probably something that needs to be added to the mix when thinking about Pillar 1 and Pillar 2. Obviously, there was been a change in presidency in the US with the Democrats getting into the White House. As part of Joe Biden's election manifesto, he would have mentioned wide-ranging tax changes. However, due to not having the anticipated level of control in the Senate or the House, some of these proposals are potentially going to be watered down. And I suppose just based on the latest Ways and Means proposals for tax reform in the US, potentially looking at a tax rate of up to 26.5%, guilty the regime by which the US tax control foreign companies. So if it has a subsidiary in Ireland, potentially looking at the rate going to 16.5% there. However, in the last couple of weeks, the US have said that they will cap it at 15% if there is agreement on the Pillar 1, Pillar 2 profile. And then BEAT. So BEAT is whereby the US seek to deny a deduction where there is outbound payment of interest, royalties, and other such items from the US. So they're also looking at reforming that. I think the key takeaway from this slide is that, for US multinational companies doing business in Ireland, that there is quite a lot of change from a Pillar 1, Pillar 2 perspective, but also potentially with the US changes layered on top. So it's a case of staying close to those changes and potentially understanding how it may impact on your business locally. And with that, I will hand over to Fergal.
Thank you very much, Anthony. So my name is Fergal Kenzie. I'm a director here in Deloitte, and I specialize in tax controversy, which is broadly any scenario where the revenue commissioners or indeed the collector general will involve themselves in the affairs of our clients. My piece today is to just look at the finance bill and its impact on that revenue engagement piece. Particularly four areas. We'll open up with the code of practice. We'll move on to some specific finance bill changes as they relate to tax geared penalties. As we know, they're housed in 1077F, is now taking over, from 1077E. We want to look at tax defaulter publication. So section 1086, a new provision will apply from the passing of the bill, 1086A. And lastly, there's been some light touch changes to the tax appeals process. So thank you, Carmel. Just to set the scene as such, in any revenue engagement, the code of practice is front and central. And at its birth, the code of practice was an administrative basis, really setting out a set of guidelines for both revenue, taxpayer, and tax agent to follow in a revenue audit process. Fair to say it's a living document. It adapts and has changed over the years. The current version as it sits today was last in place from the 19th of October 2019. Over the years, much of the code has been given a legislative footing. Some of those we'll see later on as we work through this. And obviously the point or the takeaway there, something on a legislative footing probably leaves less ground for interpretation as opposed to something on an administrative basis. When we speak about the code of practice, we can't avoid that volume of terms that is qualifying disclosure, whether it's prompted, whether it's unprompted, the nature of tax default, whether it's a careless behavior with significant consequences or careless behavior with insignificant consequences, whether it's deliberate behavior, how all those onward reach to tax geared penalties, and how all those onward reach to tax defaulter publication and exclusions from tax defaulter publications. So it really is the cornerstone of that engagement, especially from a client and practitioner perspective, to fully understand your direction of travel in light of those terms. For the practitioners on the call, just to bear in mind, there is skin in the game. There's certain provisions under code and law. Some of them are mentioned there. Section 851, the revenue have the power under their confidentiality provisions to report a professional to their professional body. The concept of cooperation is fundamental to penalty determination. So where an agent or a practitioner is not cooperating, that can bear out in a penalty that your client may receive. And then there's the general provisions around 1055, where conceivably a tax agent could be assisting a taxpayer in the making of an incorrect return, or the more nastier stuff in the space of 1078, which is your revenue offences. Just lastly, on the code of practice, it's not the public knowledge, but currently the code is under its most significant reconstruction. It's earmarked to be released in February. I believe they are on track to make that date. The mood music to this point is, in terms of that significant change, that as we sit here and now, there is a bundle of non-audit compliance terms. For example, aspect query, profile intervention, e-intervention. All of them are typically non-audit, so a taxpayer reserves the right to make an unprompted disclosure. Revenue sense is they're not really getting bang for buck from that process, and in light of that, as things sit, it's not final, but the direction of travel is likely to be that an aspect query, or in the new world, what they're going to classify as a level 2 risk review, a taxpayer will not have the right to make a prompted disclosure. What that means is, from my perspective, they're immediately into a higher penalty bracket and one step closer to the concept of tax default or publication. So it will be a significant change if as it sits is the final version. So next slide, please. So in terms of some key changes arising from the finance bill, we'll start with penalties. This is 1077E. Going to 1077F. So 1077E is going to be stood down in its entirety. Really, what the provision is doing is I bracket it into two things. For anybody who's taken the time to look at the code of practice and look at that page where all the penalty rates are set out and all the various permutations, what 1077E is trying to do is describe that in words, and that's a difficult challenge. So what the first point of 1077F is to attempt to make that a smoother journey. And in fairness, it is somewhat easier to navigate. More importantly, in terms of changes, what the finance bill has done is bucketed more of the code into law. So the concept of innocent errors, technical adjustment, and tax defaults that are less than 6,000 and not delivered, i.e. they're careless, are now all coded in. And these are specific provisions where a taxpayer is not subject to a penalty. Interesting one, can't say I've come up against it too often. It's specific to tax geared penalty where no return has been filed. Previously, the calculation of the penalty would have been on the difference between the tax at the date of the revenue audit, the change from the date of the revenue audit to the ultimate resting position. Now it's going to be to the date of notification, i.e. somebody filing a return minutes before up to minutes before the revenue audit can't improve their hand from the perspective of the calculation of the penalty because it'll be backdated to the lay of the land at notification. Lastly, in terms of offshore matters, so the backdrop here is back to April 2017, where thereafter, i.e. 1 May, it became, there was a prohibition on making disclosure where there were certain offshore matters. So this was income accounts, offshore income or assets, etc. Those provisions are removed under finance bill. Next slide, please. Just to pick up on one of the points mentioned in terms of revenue coding in innocent error and technical adjustment, the hallmarks of both are set out in the screen. So this is where a taxpayer and our agent look at a set of circumstances and believe a penalty doesn't apply, and where you have to make a submission to revenue either under innocent error provisions or technical adjustment provisions. I would say I've rarely found myself in the innocent error camp, but we would regularly find ourselves in technical adjustments, sweeping statement, but transfer pricing and certain VAT circumstances very much lend themselves to technical adjustments. So it's just to bear in mind on that revenue engagement piece that there is certain weaponry there to avoid tax geared penalties. Interestingly, even in the journey of a revenue audit, after disclosure, where certain liabilities may unearth themselves and put pressure on disclosure and in turn put pressure on publication, sometimes you can find that technical adjustment or innocent error could offer an honourable out to all sides in terms of how they can be managed. But again, you have to meet the hallmarks of both as set out. Next slide, please. Moving on to publication, so fair to say it's an unwanted tattoo, remains so to this day. In terms of finance bill, there's multiple changes. First and foremost, the quantum of €35,000, which was a tax, interest and penalty figure, has now increased to 50,000 in tax alone, so no interest and penalties. Settlements may now be published where refunds have been incorrectly claimed, and obviously one of the statutory exclusions are not met. Surcharges will now be publishable. If I take a mind's eye of your typical tax defaulters list, you're working across from taxpayer's name, address, occupation, you run into your tax, interest, penalty total, your little blurb on what happened and then what was paid. It looks like there'll be a new column for surcharges. Given the finance bill change. Very interesting one here. Next, a settlement today as things stand, in order to be bundled into that calculation to see should a taxpayer be published, i.e., are they over €35,000 and no other statutory exclusion is met, the default must attract interest and penalty. From the passing of the finance bill, that has changed now only to tax and penalty. Next one, just in terms of more administration, the details to be published can now include a previous name or a trading name. And lastly, fixed gear penalties are now going to be also publishable. Sensible logic would say they'd be bundled in on top of the penalty column in the actual list. Just to pick up on some of those, the increase to €50,000, very much welcomed from the perspective of my sense is interest is, if I take the example of, say, myself and Anthony have the exact same tax problem, and Anthony's is a year earlier, and because of that interest clock is running a year earlier, it might be that very interest calculation that pushed him over the threshold. So to measure something off just tax alone, I think is fair. That said, and it's probably it's not for today, but 50,000. There's no concept of relativity on a measure. So a PAY worker in the country has the same threshold as the multinational sector. The removal of the interest as a criteria is interest. I think this is a nod towards real-time interventions. So we've gone through a phase of filing our corporate tax returns for FY20. I know my colleagues are working on the FY20 income tax returns. So imagine a scenario where an audit is pulled on one of those returns and the refund may not have issued, a stop is put on it, there transpires to be adjustment. Invariably, because there was no money, there was no loss it was a timing issue, interest wasn't triggered. It was a way out of publication. Hereforth, that's no longer the case. So things are going to get a little bit more interesting. Refunds incorrectly claimed, obviously that puts things like R&D, EIIS, pensions, etc. front and foremost. Taxpayer's name, there was rumor of a dark art. If I take the fictitious example of my non-existent brother of James Kenzie Limited, if he ran into trouble and was going to be a published tax defaulter, he might have been named as Seamus O'Chwinnig Cho, and my mother might not have picked that up if she was reading the paper, but hereforth, it will be revenue have the power to use a prior name or a trading name. So that practice, and sorry, a PO box may have been used by an address. So that practice of trying to put distance between what revenue we're trying to achieve is very much diminished. Lastly, in terms of slight change in one provision of the appeals process, so we're in 949AQ, which is cases stated for the High Court. So the scene here would be an audit or an intervention resulting in an assessment being raised by the revenue commissioners. The taxpayer wasn't satisfied, appealed the matter within the 30-day window, went before or through the tax process. The commissioner sided with the revenue commissioners and issued a determination, and still the taxpayer is not satisfied and wished for the case to go to the High Court on a point of law. What the Finance Bill has just set out some really administrative dates as to how that process plays out. There's a 3-month window for the appeal commissioner to get the cases stated before both parties, i.e. revenue and taxpayer. The parties then have 21 days to make any representations or observations on that draft of the case stated. Thereafter, the appeal commissioners has 21 days to get it to the High Court. In short, it's moving the process quicker. Just to put that into some perspective, between March 16, which was the birth of TAC, and year-end 19, there was 5,800 appeals lodged through the door of the Tax Appeal Commission. Only 23 cases actually went for a case stated before the High Court. 4 didn't proceed, so you're talking about the space of 19. So it's not an everyday occurrence. Just some rationalization in the Tax Appeal Commission. They're ever looking to improve their process. Some of you may have picked up some commentary by Mary Claire Manny, the chairperson to TAC, who went before the Public Accounts Committee late summer in around July. interestingly, she set out the plight of the tax appeal commissioner very, very well, where she referenced a case she made a determination on, and at that time it was the largest decision in TAC since March 16. It was 587 million in a stamp duty case, but she referenced to say she's made a determination on a case of 600 million. Equally, she's made a determination of cases of less than 600 euro. And that no legislative body would have such a bandwidth. So there's winds of change are coming. They're introducing a tiered system. They haven't defined what those tiers are, but there will be some alignment of an appeal case now into a tiered system. Logic would say it would be based on quantum complexity and perhaps the expertise of the appeal, or the need from the appeal commissioner. And all that is driving towards a more efficient appeal process. So that's the end of my piece. I think, time permitting, we're going to open the floor to questions and answers.
Great. Thanks, everybody. We do have a few questions in. So the first one is, I think it's for Carmel. Is there any confirmation letter required from the employer to confirm that the employee was working from home?
No, not at the moment.
Perfect. And then the next one, does the EWSS registration cutoff date only apply to new registrations, or does it apply to re-registrations only?
The wording is around new entrants. So I think in the case of somebody who might have availed of it previously and has come out of it, I would certainly be getting myself back in, I suppose, before the end of the year to avoid any ambiguity there. But certainly it's worded as a new entrant. If I was being cautious, I'd say if I was really looking to re-enter, I would be concerned that I would fall into that bucket if I wasn't in by the 1st of January.
Okay. And then Fergal, will the changes in the publication rules result in more publications taking place?
Slightly crystal ball gazing. What I actually did was, out of curiosity, I looked at the last tax defaulters list, which is probably fair to say in a COVID world, not your typical traffic in the space. And what I did was, there was 18 entrants on it. Had the provisions as they stood today, as proposed in finance bill applied, 12 of them would have fell off. So i.e. they were under that space of 50,000 euro. So my sense will be we'll see less of that volume up to 50,000 euro in tax, and I think that will result in less. But I wouldn't, beyond that, it'll just mean less reading.
And then Anthony, do we know the timing of the commencement order for the digital gaming credit?
At this point, unfortunately, not. I was reading some commentary in the media earlier on this week, where they said basically each case is taken on its merit. So I suppose it depends how those initial discussions go. From when I look across the water to the UK, I think it took upwards on 12 months. So there's probably a little bit to go here, shall we say, before we're fully operational.
Okay, I think we've maybe 2 or 3 more questions if you do have time. Fergal, is there anything taxpayers should be considering now in light of the changes earmarked for the Code of Practice?
Good question. What I would highly recommend in light of the winds of change is for taxpayers to really consider that kind of proactive approach to tax as opposed to the reactive, and that's self-review, self-correction, unprompted disclosures, because it looks like the world of prompted is going to dominate that future engagement. And when you're in that space, you're in a higher penalty bracket and closer to tax default or publication. So, change the script a little bit, change your profile with revenue, where revenue see a taxpayer self-reviewing, self-correcting and or availing of disclosures. The risk rating, in theory, sweeping statement, I appreciate that, should go down. So, the takeaway here is very much, if there's something in your locker you feel might attract the attention of the revenue commissioners, my recommendation would consider that proactive approach.
Okay, great. Carmel, what do you think is the driver for the CAT change to the free use of money?
I think really the driver has been that, I suppose, free use of money has, by virtue of the comparison to the deposit interest rate achievable, has been in a different a different stream, I suppose, to the other things like free use of property that people might have been able to avail of. So naturally, if you free use of property, you had, we've all seen very strong rents for a long time. So the comparison there would have been completely different to the deposit interest rate. So I think that's probably one of the drivers. And I guess also it's a way, I suppose, to potentially capture from a revenue point of view, more tax from their point of view.
Okay, and another one for you, Carmel. Do the changes to the EIIS scheme go far enough?
No, like if you take them in isolation, they certainly don't, but they're certainly a stepping stone in the right direction. And I guess bearing in mind the stakeholder review that was undertaken last year, you would hope that it would be followed up then by further changes again, potentially next year and thereafter, to make the scheme more accessible and better for companies as a means to generate finance.
Okay, great. Anthony, what is the current state of play with regard to the US tax reform?
That's a good question. I think it's changing weekly. I suppose we're keeping close to our colleagues in the US and in Washington. They're hoping that they will have agreement before the end of the calendar year. That's currently where the thinking is. As I kind of referenced and probably ran through quite quickly, the lawmaking process in the US is extremely complex. So you need agreement in the Senate, the House of Representatives, and then the President to sign. So in the Senate, Democrats and Republicans it's 50-50, and the majority in the House of Representatives is only 8. And there already are some dissenting voices among the moderate Democrats with respect to an increase in a corporation tax rate. So I think while they thought, the Democrats would be an issue, they tried to take that off the table by routing this legislation through what's called budget reconciliation. But now there's some dissenters within the own party. So I think we've a way to go, and it's changing it week on week, unfortunately.
Okay, and then last question, Fergal, is there any flexibility when it comes to penalties and/or publication?
Probably if I take the last 10 years, what I've seen is the code has become much more kind of that Bible and the measure stick for determining penalties and thereon publication. What I would say is, and I probably touched on a little bit of it in my piece, is the flexibility is probably, if there's any flexibility, it's in the space of innocent error, technical adjustment. Thereafter, it's very formula driven and number driven by the grids, for anybody that knows the page in the code of practice. But I think if you can get, and it'll probably take a little bit of engagement with revenue, that if you can get into that space of innocent error, obviously that will only go so far, but technical adjustment, I think that's where your flexibility, everything else, it just lands where it lands by virtue of the structure of the law now, and best described in that page in the code, where you've either made a disclosure or not, it's qualifying or not, you've cooperation or not, and then there's a mathematical test to determine the difference between careless behavior with or without significant consequences. Deliberate, it comes down to intent. There could be a little bit of interpretation in that space, but I think to sum up, very little, but that's not to say you can box clever with what you have. And the obvious one for me would be technical adjustment, could be an honourable out in certain circumstances.
Great. I think that's all the questions we have. So I'd just like to thank Deloitte so much for joining us today. We've really appreciated your time, and I hope everyone enjoyed the webinar. The contact details are there for all of our speakers. So if anyone does want to reach out directly, please let us know, or please reach out directly, and we will make the recordings and slides available after today. Thank you.